Income splitting is a tax planning strategy that involves transferring income to family members in lower tax brackets to reduce overall tax liability and maximize savings. But it's more than just a tax strategy. It's a way for business owners to optimize taxes and support their families financially. By sharing income with family members in lower tax brackets, you can take advantage of Canada's progressive tax rate system to lower your overall tax liability and help your loved ones meet their financial goals. In today's video, we're diving into 8 practical strategies for income splitting that every Canadian business owner should know. Whether you're a young entrepreneur or retirement age business owner, there's a strategy here for you. First, let's talk about who is eligible for income splitting. Generally, income splitting benefits business owners with significantly higher income than their family members. Eligible recipients of split income include your spouse, adult children, and sometimes even minor children, depending on the method you use. But there are key rules to keep in mind, specifically around tax on split income, or TOSI. TOSI prevents unfair tax advantages by taxing certain split incomes at the highest rate of 53.53%. TOSI applies to taxable dividends, capital gains, and income from trusts or partnerships unless certain exceptions are met. Don't worry. We'll show you strategies where TOSI won't apply or can be managed effectively. Strategy number 1, paying a dividend to family members who actively work in your business. For this to work, they must be at least 18 years old, work at least 20 hours per week on average, and keep timesheets, and receive a dividend amount appropriate for their job description. Dividends received by family members are not subject to TOSI if the CRA's conditions are met regarding age, hours worked, and payment of a fair and reasonable amount. Recall that TOSI dividends are subject to tax at a rate of 53.53%. Strategy number 2, paying dividends to family members who are shareholders of an excluded business. 4 conditions must be met for the business to be excluded from the TOSI rules. First, less than 90% of the company's revenues are derived from services. This works great for non-service-based business industries like retail, manufacturing, or restaurants. It can also work for service-based businesses that also sell goods, so long as the revenue from services is less than 90% of the total company's revenue. Second, the family member receiving the dividends must own at least 10% of the company, including both votes and value. Third, the family member is at least 25 years of age. Fourth, the business is not a professional corporation incorporated by a doctor, lawyer, engineer, and so on. Paying a dividend to a family member of an excluded business who is in a low tax bracket will reduce the family's overall tax burden. For example, a family member who receives an ineligible dividend of $50,000 from a family business will pay only $2,575 of personal income tax, providing he has no other source of income. Strategy number 3, paying salary to family members who work in the business. Paying a salary to a family member who works in the business and is in a low tax bracket will save taxes. A fair wage must be based on the job description and hours worked for the salary to be a tax-deductible business expense. Furthermore, an employment agreement should be prepared that clearly states the family member's responsibilities and duties. There's a slight caveat here, which is that you can pay above the fair wage to reduce your overall tax burden. Just make sure the tax savings for your family outweigh any company tax losses on the excess wage. Here's an example to show how that would work. Let's say Alfonso pays his daughter Tia $40 per hour for administrative tasks, while the fair wage is $18 per hour. In this case, Alfonso's company would lose $2,640, which is 12% the corporate tax rate on the non-deductible wage of $22,000. However, $2,640 is significantly less than Alfonso would pay if he were to take the $40,000 income for himself, assuming he is in the highest tax bracket, 53.53%. In this scenario, Tia could potentially pay $0 in taxes if she uses the basic personal tax credit of $15,705, with the remaining amount being covered by tuition credits. Additionally, TIA can contribute that income to her RRSP and TFSA. Option 4 is for those approaching retirement, where income splitting offers even more flexibility. At age 65 or older, you can pay dividends to your spouse without triggering TOSI, regardless of whether they're involved in the business. This is a fantastic option for reducing your household tax burden and ensuring financial security for both spouses. Strategy number 5 is in regards to RESP contributions. While these are not necessarily related to the business, by funding a registered education savings plan for your child, you not only save for their education, but also shift taxable income to them when funds are withdrawn. Plus, the government matches 20% of your contributions through the Canada Education Savings Grant. Win-win. Number 6, the lifetime capital gains exemption. Did you know income splitting can help during a business sale? With the family trust, you can multiply the lifetime capital gains exemption among family members. Each beneficiary, like your spouse or children, can claim up to $1.25 million tax-free in capital gains. That means for a $5 million business, a family of 4 could avoid all of the taxes on the sale of the business. This next strategy is useful if you own real estate or other investments. When you create a corporation and give each family member a share, their dividends will be based on their income bracket. If your adult children are involved, they are usually in the lower income brackets and would therefore pay less taxes than one individual alone. For example, if the company generates $10,000 annually, your family of 4 could each receive $2,500 taxed at their personal rates. This avoids TOSI if the family member is at least 25 years of age and owns at least 10% of the company's shares. Finally, gifting personal assets to your children can be a tax-savvy option. Let's say you gift land or gold to your child. Any future capital gains are taxed in their name, likely at a lower rate. Just remember, this applies to personal, not corporate assets. Income splitting is a powerful way to keep more of your hard-earned wealth while supporting your family. From paying salaries to leveraging exemptions, the right strategy depends on your unique circumstances. Have questions about what works best for your business? Talk to one of our tax professionals to ensure your plan maximizes savings and stays compliant with Canadian tax laws. Thanks for watching. Don't forget to like and subscribe for more practical tips to grow your business and save on taxes.